Welcome to Objective 6 in Unit 1 of Accounting 3310. In this objective, we're going to take a look at another step in the accounting information system process. Once we have a set of ledgers, we next will put them into the form of a trial balance. Our objective here is for you to be able to summarize ledgers into a trial balance and to see how a trial balance is used in an information system. The trial balance has a role in summarizing information. It's a list of all of the accounts with their balances as of a particular date. The purpose is to check on the accuracy of posting journal entries to ledgers by proving whether total debits are equal to total credits. If each journal entry is balanced with debits equal to credits, then when those entries are transferred into ledgers, we ought to maintain that same equivalence for debits equal to credits. However, whenever you have additional processing, there's the possibility of introducing inaccuracies. It also establishes a convenient summary of balances of all accounts that can be used for preparation of formal financial statements. Here's what a trial balance would look like in a very short form that can fit on this slide. They're usually prepared with the balance sheet accounts first, followed by the income statement accounts. So here you can see that we've got each account listed plus their balance. So we have two columns here, one for debit and one for credit. And we have totaled the debits to $88,000, totaled the credits. They match exactly $88,000. Trial balances are typically created at the following points in time. Immediately at the end of a period, we'll gather together all of the balances based on the journal entries that have happened so far. This gives us an immediate check for errors that can be identified so that we can make those corrections. It also helps to identify any adjustments that are needed. So we have the possibility that we have recorded in our entries resources that have now been used, or we may have expenses that haven't been recorded yet. Looking through the trial balance will help us to identify those places where we need to make adjusting journal entries. The title of this trial balance is Unadjusted Trial Balance because there's going to be more journal entries to be written in the period. After the adjustments are made, and before creating financial statements, we create one more trial balance that includes all of those adjusting journal entries. So at this point, every journal entry pertaining to the period has been written, and we have the accurate information that can be used now in creating financial statements. This trial balance is called the adjusted trial balance. After we've created financial statements, the books are closed for the period. That means that all of the temporary accounts for the income statement and for the statement of stockholders' equity are transferred into the permanent accounts. So revenues and expense numbers are transferred into retained earnings, and dividends declared is transferred into retained earnings. So at that point, all of the revenue and expense and dividends declared now are reset back to being a zero balance so they can start to gather information for the next period. That trial balance then gives the opening balances for all of the accounts for the next period. Remember in the ledgers when we said that in an ongoing business there's going to be some kind of beginning balance? That's the beginning balance here from the post-closing trial balance. Only the permanent accounts have balances here, and all of the temporary accounts, those on the income statement and dividends declared, have zero balance. They have no debits and no credits in them. Let's talk about one of the primary purposes of a trial balance, which is error correction. There are some things that can be found, but not every error possible is going to be identified. First of all, we'll ask, do debits equal credits? If they don't, then something's gone wrong. The most likely thing is that a journal entry has been incompletely posted, so that only one of the accounts was posted and not the other. Or maybe we have a double posting where something was posted twice. Or maybe we have a case where something that should have been posted as a debit in fact was posted as a credit. All of those are the kind of usual errors that happen in accounting information systems. Another thing to check is, are all of the assets and the liabilities of a company listed? When one has the complete list, you can match the number of accounts to make sure that everything is there. Are all of the revenues and expenses listed? Looking through that list, you may be able to identify some omissions. Then again, we want to see, do all of the accounts have their normal balances? That is to say, are asset accounts listed as debits? Are liability accounts listed as credits? Is the contributed capital account a credit balance? Are the revenues credits? Are the expenses debits? Is dividends declared a debit? If not, most likely something has gone wrong. Another item is to see if there's any unexpectedly large or small balances. In entering numbers, it's very easy to add a zero or omit a zero, and so that can end up having some face validity that those balances just couldn't possibly be right. Finally, we're going to look to see if all of the adjustments have been made. Have we accrued expenses not yet recorded, such as depreciation or interest that's owed? Do we show the amounts used out of prepaid assets, such as insurance or rent, or are they still at their initial amount that we posted for the year? Have we recognized revenue from all of our customers, including those who haven't been sent invoices yet? Have we recognized revenue from customers who paid in advance and now have received goods and services, or is our unearned revenue account too high? These are the kind of questions we can ask from a trial balance. However, it is certainly true that there are other errors that we will not find. If a transaction is recorded with the wrong amount or in the wrong accounts in journal entries, and they've been posted accurately from the journal entry onto the ledgers and now summarized on the trial balance, we are not necessarily going to be able to identify that, because debits will still equal credits, and we won't be able to tell what the underlying individual amounts are. So there's only so much error correction that we're going to find in the trial balances, and an audit of the books of the company are going to be a way of determining other errors. Entities that use a cash basis accounting are not going to need to make adjusting journal entries, but adjusting journal entries are part of the usual system for an accrual accounting system. The accrual accounting system is set up to record entries as the source documents become available. Adjusting entries are those entries of economic events that have happened but don't have source entries. The kind of things that we're going to be looking for as adjustments are when we have unrecorded expenses. Those come in two forms. Either we have assets on our books that have been reduced and we haven't identified that yet. We could have supplies on our books that we've used and we've never decreased the supplies account. We could have prepaids on our books that time is expired and we've never reduced them. Or we could have expenses that have never gotten on our books because the source documents haven't appeared yet. So often we pay utilities after we've used them, so we get the invoices from our utility companies in the subsequent month. Well, that's going to be a mismatch, and we're going to need to record those kind of expenses on our books on an accrual basis along with that payable. We're also going to look for unrecorded revenues. Unrecorded revenues can happen either because we've had a prepayment from a customer and we haven't recognized yet that we've fulfilled it, or when we have a credit customer and we haven't necessarily recorded that event yet because the bill hasn't been set. Here are some specific kind of instances. If a company uses equipment in its operations, there'll normally be an adjustment because of depreciation. Many companies don't track supplies on a day-by-day basis. Instead, they count the supplies at the end of the year and record supplies expense at that time. Thus, supplies becomes an adjusting journal entry. We could have a company that pays its insurance by the year, sometime in the middle of the year rather than paying on a month-by-month basis. In that case, we often need to decrease the prepaid in order to show how much of it's been used. We also have some expenses that are typically paid after they've been incurred, such as property taxes. They sometimes don't need to be paid until the next year, and so we'll have to accrue them, record that expense, and record that we have an obligation to pay it. Likewise, as we've been talking, we may have a prepaid contract with a customer that we've already fulfilled, at least some of. We would need to show the decrease in that obligation. In summary, the process is to create an unadjusted trial balance from all of our ledgers at the end of a period, then to take a look and see what adjustments are needed and record those adjustments. That gives us new balances in our ledgers, and we need to create then a new adjusted trial balance. That adjusted trial balance then is expected to be accurate and can be used to create financial statements. Trial balances may be created on a quarterly basis because companies need to create financial statements on a quarterly basis for the Securities and Exchange Commission. However, often management wants to know where they stand more often than just quarterly, and so trial balances can certainly be done on a monthly basis as a part of the monthly close. They also can be used whenever they're needed for information for the enterprise, such as when we're going to have perhaps a merger or an acquisition and we need to get a feel for where our company stands. We're going to take a look at putting a trial balance into a worksheet format so that it's handy to use to create financial statements. So the trial balance that we looked at before has now been applied into a worksheet format in which we have a list of all of the accounts in order of assets and then liabilities and owner's equity. And the owner's equity is in order of the permanent accounts first, and then dividends declared, and then the income statement accounts. We have the two column format where we have a debit column and a credit column that verifies that debits equal credits. This worksheet then has columns for us to use in order to create our financial statements. We'll wait and finish that up in our next objective. Thank you.